Welcome viewers. My name is Mark Joliker and I'm here today to talk about cash and margin, how I use it in my income portfolio, and also to talk about some cool ETF funds you can use to help hedge your portfolio for various regimes. And first, our disclaimer. This video is for educational and entertainment purposes only. I'm not a financial advisor, and nothing in this content should be construed as financial advice. Always do your own research and consult a licensed financial advisor before making any investment decisions, including buying or selling any securities. Before we get into the funds deep dive, we're going to talk about the macro regime. So BOXX are, as of today, the 12th of November, BOXX uptrend remains intact. It appears like we're heading for another round of all-time highs. Gold has been in a very strong rally for most of the year, and recently had a nice pullback, a nice consolidation, and now it appears the dip has been bought, and we're probably going to see at least a test of the high or potentially new highs. Still remains a 3-year range and is at the lower end of the range. Has recently had a buy signal, but today it had a breakdown as well. So we'll have to see how it evolves here. Bitcoin is in a downtrend and it should get down to the low 90s and should bounce from there. We are still long-term bullish on Bitcoin, but I need to see this correction play out. Let me jump to a few charts just to walk through these. First, the U.S. stock market. Actually, let me pull up a cleaner chart here. For the U.S. stock market, we are, we had a nice correction. We were just testing this trend line here, and it looks like we've survived the test, and the markets are rallying the last 3 or 4 days here. We'll probably see new all-time highs at the minimum, and unless there's something that stops the train is going to continue. I'm also watching. I have built this index of multiple major reflation related stocks, things like miners, copper, and a whole bunch of global companies that will improve as reflation comes back in and economic growth comes back in. You can see the last 3 or 4 days, there's been a major improvement from a big pullback, and we're about to get the buy signal here that the world is on fire. Everyone is growing globally. You can see the last time we had a dip over here. This was during the tariff tantrum in the first part of the year, not this one. And look back to last year in the November-December period, we also had this indicator dipping down. And as you can see, this was coinciding with the S&P having a bit of a correction as well. So from an S&P perspective, looks like we're about to have a new breakout. All right. The next is the gold rally. So let's take a look at the gold price. All right. Actually, let me get to the cleaner chart here again. So as we were discussing last time, gold was in a correction and it looked like it wanted to turn up. And now it looks pretty clear that it has broken out and it's going to give a buy signal here using the GLD. You can see the buy signal came today. So I actually bought in a portfolio review, we'll talk about a gold income fund that we purchased, but also in my growth accounts, I've been buying some options, some call options. Earn the money now. Oil, again, is in a cleaner chart here. Long rectangular range here for oil. We're again at the bottom of the range, kind of in a downtrend. Doesn't look like it's giving any buy signals yet on USO. You can see we did have the buy signal in USO. Green histogram here is the buy signal. But today's action was fairly negative, -4%. So that will probably invalidate this buy signal and turn it back into a sell signal. But looking for this to stabilize here in the next few dollars or 50 cents. if it can stabilize here, I think it can rally from here, but only to the top of the range again. All right, Bitcoin. We are, not much has changed since the last time we discussed. Our downtrend, it doesn't seem to be wanting to stabilize yet. Some kind of a false break up a couple days ago and retracement down. A sell signal recently went negative on Bitcoin and purchased some winter, which we discussed in our last episode. All right. Back to the agenda. So we want to talk about cash and margin in this episode. For cash, some cool funds here. First of all, I want to talk about BOXX. BOXX is basically a higher yielder, higher paying yield than holding money market or short-term treasuries or CDs. You can probably get 3.9% right now holding bills. And BOXX you can get 4.6. This is because BOXX is doing term BOXX spreads, which are synthetic cash positions that are using options on SPY and QQQ. This is as safe as cash, or almost as safe as cash, unless the manager of the fund does something to disrupt the fund. But as a cash alternative, has very low credit risk, low duration. You're basically lending to the option markets. And it's good for one other thing, it reinvests internally, so it does not pay a distribution. So that 4.6 is growing internally in the fund. It's like if you were on a drip and buying it. So let's take a look at BOXX. So as you can see, it just goes up in a straight line. Not much to see in the chart. Point is, you're making your 3.6%. And it's just like it's rebuying in every single day. All right, so and this is for neutral regime, or when you're not sure if we're heading for a recession or we're heading for inflation. Going to the left of BOXX, we have TUA. This is if we feel recession is imminent or we think interest rates will drop suddenly. That's when TUA thrives. TUA is behave very similar to other long duration bond funds like TLT, where it will jump or grow in value when there's deflation coming, when economic slowdowns are coming. 2-year Treasury futures, and basically replicating a duration of a 7 to 10-year Treasury index. It's best to use during rate cut cycles or flight to quality rallies or early recession regimes. It can replace intermediate treasuries and risk parity barbell structure. So instead of a 60-40, you could put 40% in your TUA and 60% in your equity pie slice. And let's see price action here. So TUA, you can see it has swings up and down. And you can see back in May of 24, it bottomed out, and we had a kind of a recession fear in 2024. And you can see this rallied quite a bit. Then recession fears tapered off, and it comes back down. So you can see it's kind of in a tight range, within a 20% range, and it pays you a coupon while you're waiting for something to happen. Any kind of unemployment surprise or unemployment rate spiraling, rate cuts more than priced in, recognize that rate cuts are already priced in. So this would have to be a kind of surprise rate cuts, faster rate cuts that would cause TUA to rally. And other things like credit defaults or recession triggers would cause it to rally. So you can make your 3.29 and get some appreciation if you time it right. But you have to have a belief that recession is imminent here. So on the other side of the coin, if you don't think recession's imminent, but we think we're in an economic recovery or we have moderate inflation, not deflation, then IVOL is the fund to look at. This combines TIPS, which those are Treasury securities and inflation protection securities that will pay the interest rate, will pay based on what the actual inflation was. So if we think we're getting into 3% inflation on a regular basis or 4%, this is where tips will pay well. This uses tips as kind of the core holding. 85% of the fund is tips, and then it'll add 15% of over-the-counter options, swaptions on the 2s and 10s steepener. Inflation surprises and rate volatility. It's ideal in early recovery, reflation, stagflation, and or Fed pivot regimes. So if the Fed is pivoting from cutting interest rates to neutral, or cutting or neutral to increasing interest rates, this will hedge. These are good hedges for your real estate portfolio and your stocks that are vulnerable to interest rates. And yeah, as you wait for IVOL to move, you're making 3.6%. And so let's take a look at the chart. So here you can see IVOL was in a long downtrend as interest rates were high, and as you can see, as there were recession fears and interest rates are coming down, IVOL was in a long downtrend. Back in January, it started rallying again, and you can even time it using the buy signals that we use. So you could have timed it over here in January at the beginning of the year, and would have timed it really well and got into on the IVOL rally here. And now it's kind of flattening out because we're not sure if we're going into recession or into reflation or economic growth. So we've had a pretty flat period here from May until now. Again, fund is paying you a coupon while you wait for the signal to happen. I'm kind of looking here for this start breaking out again, and if it does, I'll probably move from the BOXX fund to the IVOL fund. PFIX. So PFIX is intended for kind of that surprise inflation, or very hot inflation. So thing that would surprise the markets from being in a recession fear to being in a hot recovery. That's where PFIX will come in. The strategy is it's using long-dated over-the-counter swaptions that mimics puts on the 20-year treasuries, and it's really a convex instrument, but hedges against sharp spikes in long-term rates or rate volatility blowouts. It's best used in late tightening cycles, which we are not in right now, inflation shocks, or bond market stress. So think of 2022, and it's if you have a lot of long duration bonds, this is a hedge that will help you preserve the value of those bonds. Again, also can hedge real estate exposure. PFIX is over here. So again, if we feel inflation rebounds or have a large amount of monetization of the debt, this is kind of looking like it could happen next year. This is where I would expect PFIX to jump. But you can see here, last time it jumped, had like a little bit of reflation coming back in. We had a nice rally on that. And then now since May this year, we've had kind of the fear of a deflation or recession coming. So you can see it kind of dropping back down. So again, this is, if you have a strong opinion on inflation versus deflation, these funds could be very tactical and can help you use your returns. But right now I'm in BOXX, and I'm happy just collecting my 4.6. All right, how do I use margin? So our overall strategy we covered the last few episodes. I use cash and margin to invest in the 4 quadrants here. And occasionally we'll put in some bearish tactical funds to offset and hedge for potential market downturns. The cash funds we just covered, some of them can also behave as tactical hedges and can be used in that way as well. So for margin, I'm targeting 25% margin across all of my portfolio. In normal regimes or bullish regimes, 25% feels right to me. If we get into a very bearish regime, which would be more of a longer term, not just a short term, like 1 month bearish regime, but in a longer term regime, I might want to reduce the margin and wait for a better day so that I can buy in at full margin when we see the turn in the markets. So my goal is to use up to 50% margin when all signals are go. Giving an idea of what that looks like, I'll just pull up the S&P again. Let me get a cleaner chart. So when we have a significant pullback and all signals appear to be going back to green, this would be a good time to basically use more margin and get all in. Now, I don't always expect it to return to all-time highs. It might only halfway up, but this, at least for a few weeks, might use extra margin to juice the returns. All right, now let's pull up the portfolio and talk about changes that have happened since our last review. I did purchase a few securities, so let's just kind of go through it again. Here's my cash allocation. I've got $21,000 cash in BOXX right now. For my debt quadrant, there's not much has changed here since we last discussed. For the equity-based income funds, I don't believe there's any changes here either. For the high yield quadrant, I purchased FSK since we last discussed. This is a BDC that has been beaten down quite a bit. So let's take a look at that. All right, so FSK had a green, following our buy rules, right? It's in a downturn. It's in a downtrend. It's at a discount to NAV, and we got a buy signal. So kind of looking at the first one, I was just double checking, making sure it wouldn't return to a sell signal. And then when it held up, I bought a couple days ago. So now I'm in on FSK. The other one that I bought into this week was IAUI, which is the NEOS Gold High Income ETF. That one pays about 13% holding gold, and it holds it sells call options on the gold ETF as well, the GLD ETF. So it's pretty cool. IAU. Yeah, it was really good timing. I purchased it. I think it was two days ago, and as you can see, it had a nice breakout. It's going to at least test a new high, probably will rally even further. We'll just follow the GLD very closely. All right, my allocation, I'm pretty much fully allocated on my high yield sleeve now that I've purchased these last two. I did not buy into PBDC yet, looking for a buy signal. And just to show you, BDC. Yeah, it looks like we did receive the buy signal the last 2 days here, so I might buy a little bit of PBDC. Again, our rules are we've got to be in a downtrend for a significant period of time, and you can see that here. And then flipping to a buy signal, and also if the fund is at a discount. All right, and my last quadrant is the ultra high risky or high yield items, and I don't believe there's any new news here. 2 weeks ago, get into winter to kind of offset my large misty position, and this is something I'm just watching for now to see. It's been going great. Winter has been doing well since I bought it. But we will see in the long term if Bitcoin starts rallying. I'm going to want to drop this. This is a tactical purchase here. The MSR, which is underlying for this, is still in a downtrend, but the downtrend seems to be slowing down, so it might come back. Overall income, the fund, based on all these purchases, projected at $26.19 per month, or $31,000. Total value is $140,000, $21,000 cash. I'm using $13,000 of a margin. I potentially could add another 22 margin if we wanted to buy any more positions. And for now, nothing else is in a buy signal, so I'm just kind of hanging on, and we'll keep an eye on the markets. All right, next episode, we're going to talk about CLO funds. These are not covered call funds, but they produce income by owning collateralized loan obligations. And there's some closed-end funds we'll be talking about to kind of talk about this strategy and how this can fit in your portfolio. So we have EIC, which is yielding 13%. We have ECC yielding 16, 18%. Oxford Lane Capital yielding 18 to 20. and XFLT, which is a little bit different, floating rate item, which yields 11 to 12. So you can see here, you can get some pretty high yielders. They're currently at a discount to NAV, and they're currently in a downtrend. So these are the ones for you all to consider. And then if you like this episode, please, please, please subscribe. Got, I think, 12 subscribers. I'm a brand new YouTuber. This is my third installment. Obviously, I'm not as polished as some of the other guys yet, but I'll improve over time. What I love to hear is you leave any kind of comment in the comment section. I'd like to be able to respond, and I would love to hear what you think. If you have positive or negative comments, I'm happy to take the feedback. Please like and subscribe to the channel, and we will come back next week with more news. Thanks a lot, everyone. See you later.